Hey, let's look at chapter 15 homework. So let me share my accounting lab. All right. Go through these 17. Hopefully get through this in less than an hour. What we have here is sort of a fill in the blank. And what we're told is that this company earned $357 million of income, 357 in 2015, paid $45 million in dividends. And so we're trying to figure out how to complete these blanks. Common stock, the easy part there, first of all, is common stock is not changed, so that's going to be $100 here on this first line for 2015. Your additional paid-in capital is going to be $1245. But it says the ending retained earnings is 1104. So 1104 ending retained earnings, and OCI, other comprehensive income, 53, that's given. So if we end up with 1104, then what does that tell me retained earnings was the year before? Let me find the notepad over here. Smart notebook. So if we end up with 1104 in retained earnings for 2015, that was given, and it said our income was what, 357? So you know we're adding that because we're trying to get 2014 retained earnings. We paid out 45 in dividends, minus 45. So what does that tell us 2014 beginning balance was? Well, we take 1104. Going to add back 45, add back, not subtract, add back 45, and then subtract the 357. So that should be 792. If you're not sure, go in the opposite direction. All right, 792 plus 357 minus 45. So 792, if we go back over here to the exercise, there's my 792. And so that leaves the final number, negative 420, must have been what our OCI was. That's a very straightforward fill in the blank question. All right. I'm going to go fast. That way you can, at your leisure, stop and go back if you need to. All right. Number 2 says we have issued 1,500 shares of stock, $22 a share. That's pretty simple. That's a 2010 question for 2020. 33,000. All right. Number 3. Here we have 2,000 shares, $5 par value. So there's my $10,000. Paid the underwriter 1%. They sold the shares for $24, or what, $24 times 2,000, that's $48,000. So $48,000 minus 1% gives me $47,520. $480 from $48,000 is cash. So that's my stock issuance cost that I have to account for. Number 4, sparkling spring water. Issued 1,400 shares, $5 par value common stock. Not publicly traded. And when you see not publicly traded, that means it doesn't matter what somebody thinks the stock is worth, because that's always subjective, and they're always going to overstate what they think the value is. But what you do have is this consulting firm billed other clients $55,000 for similar services. That's a pretty good estimate. And with that in mind, that $55,000, based on the par, tells them how many shares of stock that they're going to give, which is 1,400 times $5 par value common stock. And additional, or the remainder, the plug number is the additional paid-in capital in excess of par of $48,000. That's a good exercise on fair value of consideration given when you don't know the actively traded value of stock. All right, number 5, is a stock split. What happens with a stock split? You know, from the lecture video, I talked about Netflix, 7-for-1. Now, Google had a 2-for-1 stock split. It just makes the stock price go down. It has nothing, market price go down, but it has nothing to do with what you record on your financial statements. You do make a change in the par value, but that is all you have to do. So there is no journal entry to be recorded. Number 6, it's the treasury stock exercise. Looks like that we bought 24,000 shares. I have to write this down so when I go to the notepad. $24,019. Sold 10,000 at $24. It's like they made $5 a share, didn't it? Then they sold the remaining shares at $9. Like they should have sold it all at 24, shouldn't they? 10. So let's go here and see what that looks like. There's the initial transaction, debit treasury stock for $456. Now that's a debit. There's the cash I paid. So let's go over here to the notepad. Clear page. All right, so we sold. Let's first make the journal entry up here, or the T account. Move my face out of the way. A treasury stock account sitting there with 456,000 shares or dollars, which is 24,000. That's dollars. If you look at shares, you don't have to do this, but sometimes it's easier. That was 24,000 shares. That's dollars. So what happens? We sell 10,000 of those shares, right? 10,000 shares. It's got to come out of my treasury stock general ledger at how it went in, which was $19. So what's 19 times 10,000? $190,000 is coming out, right? We sold 10,000. These are all at $19 a share. All right, and we'll see the corresponding journal entry, and then that leaves 14,000 shares to sell the second time. So there's 0 shares. Again, that's shares. You don't normally use shares, units with T accounts, but you can. It's a good way to keep up with it. And so those 14,000 shares that came out, again, is at 19,000 or $19, right? $14,000 shares times 19. It's got to come out, same cost that it went in. So 14,000 times $19. I can't do that in my head. 266, which you know has to be equal, right? 456 minus 190 minus 266, 0. All right, so my journal entries over there, we'll turn back and look at, and I won't have to spend the time writing those out. But keep that in mind, what you're going to do over here in the journal entries. All right, there's the cash I received because I sold those 10,000 shares at $24, didn't I? Yes, so 10,000, 24. So there's the cash I received. There's 190,000 that came off of my treasury stock T account out of my general ledger. And so the difference there is a gain, but we don't recognize a gain. We put it as additional paid-in capital from treasury stock transactions, 50,000. Let me go back over there and put that on there. Not sure I shared that right. Okay. So there we have additional paid-in capital, treasury stock. What did I just say? $50,000, right? $5 a share. Yep. So there's the 50,000 that I post to my ledger. This is the ledger. And what happens then? We sell the remaining shares at $9. Well, I can only take that additional paid-in capital down 50,000, right? There's my 266. So if I go back over there to my notepad, that can only be reduced to 0. The rest of it has to go where? Retained earnings as a loss. There's the 266 right there. And so there you see the cash I received, which is 14,000 shares times $9. That's 126, right? 9 times 14,000 shares, the remaining shares. Take additional paid-in capital to 0. There's the treasury stock reduction that we calculate over on the T account. And so my plug number is retained earnings. So I got to take 90,000 out of retained earnings because that's a loss, isn't it? Reduction of retained earnings. All right. Number 7. Dividends payable. What we have here, Sampson Company, cash dividend. Dividend was 65 cents per share. 130 shares issued with 12,000 shares held in treasury. So we have to subtract those treasury shares out. So 130,000 minus 12,000 is what? 118,000 shares. So 118,000 shares times 0.65 is 76,700. I don't need to go over and put that on a notepad. And so there's my debit to dividends common stock. And again, that is the same thing as retained earnings. You are reducing retained earnings. They just use a different account title, dividends common stock. It is an equity account. And then there's my dividends payable. This is when the dividend is declared. The liability, the obligation is determined when the board of directors declares that dividend. No entry at the date of record or ex-dividend date. And then at the date of payment, reduce that dividends payable to 0 and take it out of cash. All right, number 8. Number 8 looks like is a prior period adjustment. Looks like they discovered a $400,000 expense in 2012. Didn't record a $400,000 expense in 2012. Never paid this amount due on the invoice it received. Hard to believe it would go that long when they discovered the error 4 years later that your supplier or your vendor didn't know that. But be that as it may, we have $400,000 that we've got to pay for, right? And so, you know, you got accounts payable credit for $400,000. But if that's an expense, right? If you found that in the year before the books were closed, this entry would just simply be debit expense for $400,000, credit accounts payable $400,000. But the books are closed. Expenses and revenues have been zeroed out to retain earnings. So we have to put the net of tax against retained earnings. And so $400,000 at 20% tax rate means that 20% of that $400,000 is going to be an income tax refund receivable. The IRS owes you money for that. And you're going to have to actually make a cash payment to your supplier, though. But you're going to get a refund from the IRS for overpaying your tax. And the rest of that, net of tax, 1 minus the tax rate is 80%, goes to retained earnings. Good exercise there on prior period adjustments. And we'll encounter that again in a few more chapters, either 20 or 21. But it's good this is something you will encounter in your career. Then number 9, another prior period adjustment. What we have going on here says during an audit, discovered the firm did not record a $1.5 million expense in 2012. Never paid this amount due on the invoice it received. Discovered this error in 2016, and so we need to restate the prior year, don't we? So let's see here. In fact, they give you the journal entry. All right, so you don't even have to do the journal entry. There's the journal entry. And so what's relevant here is this $825,000 retained earnings. So 825. So we need to make a prior period adjustment for that. We need to put in this information that has to do with our common stock, 1.7 million and 18.5 million additional paid in capital. That's just a copy from this data table. Slide in there. There's your retained earnings, 32,840, but we need to correct that, don't we? 32,840. All right. But what we know here is, I'll let on one screen, what was previously reported. 1/1 of 2016, previously reported. So 23,725 is what we got to start with, not the 32,840. You can arrive at the 32,840 by taking into consideration what they had here, the 23,725 plus net income minus dividends. That gives you that. But you want to start with your last known retained earnings, which is 23,725. The 23,725 prior period adjustment we just found on this journal entry, right? There's my 25. We're going to what? We're going to subtract that out, which gives us an adjusted retained earnings of 22,900. Then we're going to add the net income for the year, which comes off of this, 94,665, and we're also going to subtract that 350,000. So that gives us our new adjusted retained earnings for 12/31 of 2016. Okay. Number 10. Looks like we have a stock issuance exercise here. Report the following shareholders' equity section at the beginning of the current year. All right. If I can keep that active there. Issued 150,000 shares. I'm looking through this on my notes of how am I supposed to show you this. I probably don't have room to do all that on Notepad. Let's see, we'll try to. Let me write all this down. I think Pearson would let me, as an instructor, know what all this information is. And then just pull it up, but they don't. They give you a different set of numbers every time you pull it up. Let's see, track shares, paid in capitals. Common stock, 180,000. Guess I could have paused the video. So our first entry here is 150,000 shares times 75 cents for par gives you the 112,500 common stock. Which is 150,000 shares. It was issued at $54, it looks like, 54 times 150. That is the 8,100,000. And that 8,100,000 less my 82,000 in underwriting fees gives me my 80,180,000. Right? Okay. And so if that's 8,018,000, my 112.5 gives me a plug number there, 79,05,500. All right, let me go over here and put this on the notepad. If I can write smaller. All right, so we've got a common stock account that started out, the original balance of 180,000. We just made that journal entry for 112.5, didn't we? All right. We also have retained earnings of 20,900,000, and we have paid in capital that had a beginning balance of 10 million. And we just made that journal entry, right? And we posted here to our ledger, 79,05,500. All right, and our shares of common stock, one of these shares down here at the bottom in red, you start with 216,600, and we just issued 112, didn't we? What's the next question? So we just posted that. So what's the next question? Declaration of payment of cash dividend. So the cash dividend is going to be based on adding those two numbers together, which is number of shares. That's 366,600 shares. $9. I don't know what my calculator went dead. $329,940. I left a digit out. I think this calculator's quit on me. Well, calculator quit on me. 366.6. Times $9 was the answer we just looked at. 3299400. $366.6 times 9. Got to make sure you get all your shares outstanding. All right. So that's a reduction of retained earnings at 3299400. All right, dividends common, reduction of retained earnings. And then there's the payment, reduced dividends payable to zero. I didn't do a T account for that because that's not necessary. And so now we need to put our statement of stockholders' equity together. Shares authorized, shares issued, but they left off outstanding. There should be a notation here, shares outstanding. Well, that answer is 366,600 outstanding. Additional paid in capital, 17,905,500. All right, there's that balance. Common stock 3025. I don't think I don't have to assume what's in there is right, but my calculator's died on me. It worked that time. 17,600, 600. So those numbers should be what we put on our ledger, or our, statement of stockholders' equity. There it is, 17,905,500, 292,500. Retained earnings. Oh, I left something off on retained earnings, didn't I? Was there income somewhere up there? There it is, 6.5 million. I left that off. So we need to go over here. $6.5 million. Make a new total, right? 0, 0, 0. That's a 6. 24,100,000. 600. Got to make sure you put that net income in there. There's your dividends. $24,100,600. OCI didn't change, neither did treasury stock. All right. If everybody can see. The one thing they did leave off, they should have put shares outstanding. Shares issued minus what? Treasury stock, 23,400. 390,000 minus 23,400 gives you number of shares outstanding. 366,600. 366,600. All right, number 11. Treasury stock. Looks like we started a year with 119,250. I've got a note here to track treasury stock. 119,250. So we've got several transactions to go through here. There's my treasury stock transaction, $20 at 17,000. That's pretty clear. $340,000. think I need to track retained earnings as well. Retained earnings started with 2023000. $17,000 shares at 20. Shares. These are $20 a share cost. Sold 4,300 shares of this at $22 per share. So 4,300 times 22 gives me the cash balance, or the cash received, 94,006, but 4,300 at 22. $4,300. So 4,300 times $20. I'll do that in my head. 2 times 3 is 6. 86. About 86,000. Got to come out at $20. Same way it went in. So there's my 86,000 we just calculated. The difference goes to additional paid-in capital from treasury stock, 8,600. APIC, treasury stock. You got to put it in a separate account. You can't put it in common stock APIC. All right. Then we sold 7,300 at $7. Well, 7,300 times $7 is 51,100. Those 7,300 shares at $20 is 146. So 7,300 times 20. Just said it's 146. Run out of space if there's another entry. And so that's a loss, right? $7, you paid 20, so you're lost $13 per share. We can only take that additional paid-in capital down to 0, so that's 8,600. And so the difference is going to be retained earnings for 86.3 that we post. So that's your plug number, 86.3. From 8,600, that goes to 0. It can't have a debit balance. And retained earnings, I'll just say 86,300. Yeah. All right. It's got to come out of retained earnings. Finally, said they reported a loss of $396,890 for the year. Closeout income summary. So the loss tells you it's got to be a debit. $396,890. $396,890 loss to retain earnings. A long problem. And then we paid a cash dividend, didn't we, at year end? of $1.70. So what is our balance of shares? I didn't fill that in there a minute ago, did I? What's the shares, treasury stock shares outstanding? 17 minus so I've got 5,400 treasury shares, don't I? And based on what was given, I had 119,250 common shares outstanding. Common shares outstanding. So 5,400 from that is 113,850. Treasury stock, you do not pay dividends. So 113,850 times, what did we say? I've got it here. $1.70. Is 193,545 dividend. $193,545. There it is. There's the dividend payable. So now the question is, what does my stockholders' equity section look like? Well, if we go back over here and add up all of these accounts, treasury stock is going to be $185,400. What's my retained earnings going to be? Well, I didn't put my dividends in there, did I? 193,545. So 2,023, 86,3. 396,890 minus 193,545. That looks like the balance is 1346265. All right, so 185,400 and 136. 1346,265 should be what's over here. There it is, 1346,265. Common stock, I don't think it changed. 954, yeah, you can see 954, 143.1, those didn't change. We're done with that. There's my new balance of retained earnings. My treasury stock at cost, 108,000. Is that right? I thought that was a different number. At 185, I calculated that wrong. I can tell by looking at it. That gone calculator. Yep, 108,000. Maybe it was me and not the calculator. 108,000 for treasury stock. All right, that's a little bit lengthy problem, but that's another good one. There's treasury stock. Shows that you know what you're doing with saving the stockholders' equity. All right, number 12. I don't think I need to go through this. You can probably do that yourself. Let me click on the information so you can see it. can stop your video and copy it so I don't have to stay here and wait. All right, and then additional information. All right, and there's the answer to requirement A, the issuance of preferred stock. Preferred dividends. Again, dividends preferred, that's the same thing as retained earnings. And then dividends payable. There's the dividends for common stock, which is retained earnings reduction. Dividends payable preferred, dividends payable common, and then the stockholders' equity section. So that's similar to the one before, so I don't need to belabor the point and talk about it. All right, so that's number 12. But number 13. Issued callable preferred shares for $385,000. So there's the cash I received. There's preferred stock at par. Very straightforward. Part B. They call the preferred shares in. Well, simply you're going to reverse. You're going to reverse that $175,000, that $210. You got to get that off your books, right? So you got to debit that, and you're going to credit what? Cash, because these were called in. You paid for it as a company. You're making the journal entry for the company. All right, so that was fairly short and sweet. Let's look at 14. Here's another prior period adjustment. It's important because you're going to encounter this in your career. Remember, I worked over 30 years, so I've seen just about everything at least twice. And so you're going to encounter this. It says they recorded $13.5 million in depreciation expense instead of recording $9.5. So they over-reported what, $4 million of expense. Tax rate is 30%. So there's the $4 million. I got to correct my balance sheet accounts. That's what you do with a prior period adjustment. You can't correct income statement accounts. It comes back to what you learned in 2010. Income statement accounts, revenue and expense are temporary. They get closed out to income summary and get closed out to retained earnings, net income or loss. But here you got to correct your accumulated depreciation. You know, that's a two-sided entry, depreciation expense and accumulated depreciation. Depreciation expense has to be corrected through retained earnings, but you got to correct your book balance. So you want to add back $4,000 of accumulated depreciation, which is going to increase your net book value. All right, and so that $4 million, if the tax rate's 30%, what's 30% of $4 million? $1.2 million. So you owe tax on $1.2 million because your net income has gone up. Should have been higher. You overstated your expense, and the difference goes to retained earnings. And they have a little bit of information you need to fill in at the bottom. These adjustments will be reported in the closing balances on December 31, 2014, comparative statements. And so they give you what these balances, accumulated depreciation, retained earnings should be. All right. 15, OCI, other comprehensive income. What's going on here? So here we've got $192,000. I'll have to write this down too. Unrealized gains on available for sale. This will make more sense after the next chapter. And foreign currency translation loss of $11,000. Beginning balance was $200. So other comprehensive income for the current year is a loss of $5,500. which is our $11,000 loss, right? Minus the $5,500 gain. So that's the $5,500 loss in requirement A. What's comprehensive income for the year? Well, 186.5, that's your 192,000 minus your 5,500, right? Yeah, 192,000 minus your 5,500. The 5,500 is the 11,000 loss minus or loss plus the $5,500 gain. What's the ending balance of other comprehensive income? It says the beginning balance was $200, right? If you put that in the T account, $200 credit. Working on my scratch pad here. So $5,300 debit. Let me just share that with you. OCI, said you started with a $200 credit. You had a net $5,500 that we worked in that exercise, so that says you must end up with $5,300 debit. Debit, OCI, that's a equity account. So that's a loss, right? Carry forward to the next term. The next one is identical in the way it's laid out. So you can do that on your own. There's the answers. And then finally, in 17, I'm going to let you do that one as well, because this, I think we've already worked everything relative to these. There's the information. What you're doing here, it's stockholders' equity, calculating your stockholders' equity. We've done a couple of those. You have to work through these JEs, and you need to track the retained earnings, meaning start out with your T account with retained earnings, and then work through there to find out what your balance is at the end. The common stock, additional paid in capital, that probably, it doesn't change. You can see the answer right to the right of that. See right there? Retained earnings, you start with 740, credit balance, and then work through this. Buying back its own stock, right? You got to keep up your treasury stock. Maybe, there may not be any treasury stock at the end. No, there is. There is treasury stock at the end. There you see it. Okay, that is chapter 15 homework. Again, if you have any questions, being an online course, please email me and I'll help you the best I can. Pearson is very good about having Ask Your Professor through MAL. You can click on that and it'll send me an email, and I'll put obviously what you've got there that you're looking at. So we'll talk again soon. Have a good day.